Hey, Jerome Powell just responded to questions about the economy, where we sit today, pausing rate cuts or potentially going slower, and some Donald Trump insights as well as tariff insights. And markets weren't really happy with what they heard. In fact, if you just take a look at Bitcoin, for example, you can see that Bitcoin just didn't like this at all, and maybe it's something to pay attention to. You've got Bitcoin that basically topped right as the Fed's statement came out right here, and you moved straight down after that. Tesla also accelerated its decline during that, going into the close here. So let's talk a little bit about what just happened and why markets maybe cooled a little bit, going down to that 508 level after Jerome Powell's discussion and his presser, that is his prepared remarks statement. One thing I do want to note quickly as well is I did send out a free alpha report to text and email this morning talking about how Tesla was likely to go to 318 today. You'll notice when it opened, it actually opened at about 327, ran to 329, and no lines on this chart, but guess where Tesla consolidated before falling? Right around that 318 level. So if you want to watch that 318.62, if you want that report, make sure you go to meetkevin.com/alpha and you could get those insights as well. I do believe that if we don't hold 318 on Tesla, which right now we're not, we're closing around 311, probably trending back to that 295 to 300 range. But we'll see. Okay, with that said, let's get into a summary here, and that's meetkevin.com/alpha. Sign up for those texts and emails so you get that for free every day before the market opens. So what we have right now is a market that's somewhat tenuous. You have a stock breadth in an extreme fear territory, and this is important because it means the market is really searching for a reason to go higher. And you're not finding it from Jerome Powell, and that creates some nervousness. Take a look at this. This is the CNN greed and fear chart. I actually have pretty good charts on this, even though I know a lot of people don't like CNN. But stock price breadth is at extreme fear levels. This really means you have very few stocks pushing indices to highs. Like Tesla really took QQQ, NASDAQ 100 ETF, from 500 to 513 by itself. Just one stock out of 100 in the NASDAQ 100. And Tesla has a strong weight in the S&P 500 as well. But take a look at this as well. Put-call ratios right now at extreme greed levels. Only today did we see a little bit of pickups of puts, but these levels of extreme greed we haven't seen since the top of the market on July 10th. And I think this is why markets were really looking for something juicy from Jerome Powell today, so they can get a little bit more confidence that we have a license to go higher. Because what you're finding is 52-week highs are actually rotating into the fear territory. And even though market momentum overall with the S&P 500 at 6,000 is at extreme greed levels, it actually screams to you that we might be trending closer to the moving average and back down rather than up. So in other words, there's more of a risk factor here, and this is something to pay attention to. And so why did Jerome Powell not give us extra confidence today, or at least not extra confidence to the markets? After all, most people think the stock market's going to keep going up. Look at this chart right here. Percentage of Americans who think stock prices will move higher. It's at nearly one of the highest levels that we've seen since 1987 at over about 52% of Americans. We've only been there one other time thinking stock prices are going to keep going higher. We just haven't seen that very frequently. Usually you have people under the 50% threshold. So again, that put a lot of burden, if you will, on Jerome Powell to deliver some real bullishness. And I don't think he actually delivered that. Now, I do personally have some enthusiasms about certain stocks, and I'm going to be making a video on it, and we'll talk about it more in our alpha reports and that. Hint, hint, end phase in one of them. But that's really a topic for a different video. For now, let's focus on some of the things the Fed's talking about. Yesterday, you had Fed speakers suggest that they really need more data to determine how many rate cuts we should be expecting. This is nothing burger news. This is old news. We already know that. But Barkin gave some interesting insight. Barkin mentioned that we should build more homes and we should not suppress demand any further. In my opinion, this was Barkin's way of screaming that we should actually be trying to get the longer end of the yield curve down because we continue to suppress demand, and that's not good for the housing market to create the stability that we're looking for. Now, I personally think if you look at something like a 20-year bond or a 20-year bond ETF like TLT, I think this 90 level is roughly what I like to call my J-Pow floor. It's really somewhere between the 90.65 and about 80.65 level, so it's somewhere in this range right here. The reason I call this the J-Pow floor is because I think Jerome Powell in prior meetings and when you combine it with some of the other speakers, they kind of recognize that if we stay at these high levels, they're going to start causing restrictiveness and problems. And that's what Barkin actually mentioned as well. He said, look, the current level of unemployment is fine, but if it weakens more, we could have a problem, and that problem could come very rapidly. Goolsby also argues that once you start sustaining real labor market weakness, it's extremely difficult to stop that labor market weakness. Barkin goes then as far as saying, look, good right now, but let's be really clear. If we have a place, or if we enter a situation where higher income spenders start spending less money because all of a sudden they are in a place of, oh, wow, the stock market's gone down, we're going to spend less. Well, then you have less retail spending support from wealthier consumers. And when that spending support goes away, you might lose your last prop on this economy. So think about that right now. Retail sales numbers are fantastic right now. Everybody's really happy about retail sales. Everybody's happy about consumer sentiment. But a lot of these numbers are actually driven by higher income individuals who have the capacity for spending more. Well, if the stock market falls and corrects, you could see a very rapid shift in some of those retail spending numbers, and you could accelerate unemployment levels down even more, which is also not good, especially since we're already at the 1-to-1 ratio. Like, Jerome Powell successfully weakened the labor market to the point where we're like, okay, cool, we've plummeted the labor market, now let's just perfectly stop. It's kind of like trying to land a plane on a dime. You know, rather than landing on a runway, you're kind of like, boop, and then perfectly stop. Like, yeah, right. It's not going to happen, but, you know, that's at least the hope that they have. And they're talking up the state of the economy, just like Powell did today. He's talking up the state of the economy to try to, and hopefully self-fulfill that, hey, like, maybe if I say how strong the economy is, because it is when we look in the rearview mirror and we just sort of discount the October job numbers, everything's fine. Jerome Powell, even today, reiterated that, look, you know, the October job numbers were, messed up by hurricanes and Boeing layoffs and strikes. Okay, cool. So you're going to brush off the October jobs report, J-Pow. Are you just going to go mega dark and quiet on the fact that the 2 months before that we had massively negative revisions and that the trend has been down? That at the beginning of the year, we were growing by a 200,000 job pace, and now we're at a 100,000 job pace. I know he knows that because he's mentioned the decline in that pace, but just ignoring the revisions is a little bit of a problem. Talks up bullish revisions, but not the bearish revisions, which makes you wonder if, even though he says his views on inflation and the labor market are balanced, his commentary doesn't really align with that. He kind of really talks up the economy because I feel like he wants to see the labor market get propped up. And every time it comes to talking about inflation, he's actually talking about how they've basically won. In fact, even in his prepared remarks today, he says we're closely tracking the gradual decline in housing and services inflation, which has yet to fully normalize. He has, frequently been referencing how housing services inflation will come down, but I think this is really his way of trying to convince the economy that, like, hey, we're good on inflation, okay? Just please get back to hiring, would you? He does say that the labor market has cooled and there's no concern about it being a source of inflation. And I have to say, yes, the labor market is probably going to be a source of deflation. Now, this sounds like a broken record. I've said that a million times before, and I apologize for sounding like a broken record on that. But I want you to see one of the reasons why the labor market has been such a source of deflation. And SocGen actually put together a pretty good piece here. Albert Edwards put together a good piece on questioning how is Trump going to handle the collapse of workers' share of national income. Now, I'm going to save you reading this whole thing just out of respect for your time. But basically what they argue is when China joined the World Trade Organization and we really were able to start RFK just got picked as the Secretary of Health and Human Services. Anyway, when China joined the World Trade Organization, you actually ended up finding the unit cost per person relative to output prices plummet. So basically, it's a ratio, right? If your labor costs plummet and your output goes up, then you know, if let's say previously we had 100 divided by 10, let's say, and now we have, that's 10, and then we have 50 divided by 20, now we have 2.5, that ratio plummets. So in other words, as the denominator goes up and the numerator goes down, which is what we're seeing, in other words, companies are making more money and workers are making less money. When that happens, individual workers need to be more cautious about what they're wishing for. And SocGen argues corporations are able to maximize profits and may be able to do that even more under Donald Trump. But Donald Trump's protectionist policies against China could help, but you're going to want to see clear policies around this rather than just threats of negotiation, because the Main Street worker is getting screwed by high price levels and by wage gains that are so weak, they're actually potentially trending towards deflationary wage gains rather than inflation. And frankly, that has been the historic trend of globalization. People keep talking about, oh, we're going to de-globalize. People have been talking about that during COVID, and I keep saying that is the stupidest thing in the world. We're not going to de-globalize. We may have de-globalized briefly, right? We may go from a phase of de-globalization. Oh, there we go. De-globalization, right? Then COVID, and then we, so you globalization first, then COVID, then you de-globalize / localize your supply chains. And then what do? Then you re-globalize, because you could get much cheaper labor in India or in China or whatever. And manufacturing has actually gotten, pretty freaking decent in some of these areas. So I would be paying attention to this. This, I think, is very important. And they make a good point here that, no, of course you're not going to see wage deflation, wage inflation as a problem anymore, Jay Powell. That's right. If anything, you're going to see more wage deflation thanks to China and other factors. But anyway, Jerome Powell then goes on to say, recent economic strength gives the Federal Reserve the ability to be patient. And this is where he does talk about tariffs and potentially skipping some rate cuts, which was a little bearish for markets. Markets are still right now pricing in a 59% chance, so almost a coin toss of us getting a 25 basis point rate cut in December, but they're only pricing in a 27% chance for January. And that's because and then they go back to pricing in a 53% chance for March. That's because markets right now are taking him for his word, and they're basically saying, all right, we'll get a 25 in December, we'll skip January, and then we'll get another 25 in March. Now, I personally think that's ludicrous, and I personally think rates are going to drop like a frickin' rock. And I think there's a lot of opportunity for rates to drop like a frickin' rock, because the economy and the labor market is, in my opinion, destined to slow substantially more than people are expecting right now. But I don't know exactly when that's going to happen. I think sometime over the next 12 to 18 months. Jerome Powell says we don't need to be in a hurry to cut rates, and we're not going to let debt at the government level guide us, even though we're on an unsustainable path right now. We are not at an unsustainable level of debt. Now, that was somewhat bullish on people who are worried about how much debt we have, but Jay Powell said that for a while, so that's not particularly new. Additionally, The interviewer asked Jay Powell, "Hey, what happens if the workforce shrinks?" And she was basically asking about what happens if you get deportations under Trump. And he's like, "Look, I don't want to talk politics, but if you have fewer workers, less work gets done." And this basically implies lower potential GDP. So there are actually risks through some of the Trump plans that have been threatened, whether it's higher tariffs or deportations, that you could actually see reductions in workforces that actually lead us into a recession. Now, I personally think there's a chance Donald Trump opens the door to the White House and boom, we're in a recession, in January or February. But if not, it is possible that in the near term, some Trump policies like deportations or tariffs could lead to uncertainty, which then ends up leading to a recession. I think in the long run, Donald Trump's policies will probably be very expansionary. They're capitalistic. They're generally very, in my opinion, pro laissez-faire, free market. And I'm a big fan of that. But in the near term, some of the policies could exaggerate an already large issue, and that's an issue that we have with jobs. Okay. Now, the next thing Jay Powell chimes in on is he does chime in on artificial intelligence, which I want to hit. But just a quick reminder, go to meetkevin.com/alpha. I don't think you'll regret it. And if you don't like it, you can unsubscribe from it, but try it. Go to meetkevin.com/alpha. Click this yellow button right here. Join for free. Phone, email, we'll text you the message, we'll email you. You'll get the alpha report. If you want a free sample even, just sign up. And then tomorrow morning, you get your free sample. If you don't like it, unsubscribe, block it, whatever you want. But give it a try. I'm really trying to give back to the community and provide some really good value. And it's totally free. So give it a shot. See what you think about it. No plans to monetize it at this point. Frankly, I just want to grow it. I want people to be like, yeah, I want to wake up with Kevin in the morning. I think that's cool because it excites me to provide value. So hopefully you like that. Go check that out over at meetkevin.com/alpha, and I'll keep adding value to that. So Jerome Powell does talk about how artificial intelligence is also reducing jobs in whether it's fast food for ordering through, menus basically, which isn't really artificial intelligence. But he also thinks that call centers are going to basically become fully artificial intelligence based. He additionally mentions that this could increase productivity, but it also does potentially lead to more people looking for a new job, which is a downside risk factor because then if they have to go find a new job, they end up in a position where, oh no, there aren't actually that many job openings and you could see the unemployment rate rise. And this is where he does say, look, we're mindful of the risks. It seems like we're in a good place if we can stay here. And honestly, Jay Powell, you're right. If we can stay where we are, you're probably in a good spot. You're probably in a good spot if you can stay right here. But personally, I think it's wishful thinking to say that this time is different and, that we're going to be in a place of, everything is all of a sudden going to just all the decline in job openings is just all of a sudden going to stop. The increase in 27 weeks or more unemployed folks is all of a sudden just going to stop. The decrease in temporary worker hiring is all of a sudden just magically going to stop. The sudden 785,000 worker boost that we saw is going to continue so we can prop up how many government workers we have. That's supposed to stabilize and stay strong. I mean, I don't even think Doge is going to allow that to happen with Elon Musk and Trump. So I think that's wishful thinking. And then when you take out government workers, you're already negative on payrolls. You've been at negative over 20,000 jobs in the last jobs report, negative private payrolls. It's a bad trend that you're in. So at the same time, Jerome Powell's talking, and I think this is loony. I think this is just his sort of way of saying yeah, the economy's so strong right now, we might skip a meeting or two, so you effectively have 12.5 basis point cuts every meeting. Okay, well, that's ludicrous because what you're doing is the economy is so weak in the jobs market in the direction of decline that if this continues, we'll go into recession. If we stay here, fine, we'll be okay. But if we continue, we're in a recession. And yes, financial conditions have loosened right now, but that's only because the stock market has ran to all-time highs. The bond market has absolutely tightened financial conditions. Look at the 10-year. I personally, and look, I'm biased, okay, I've got exposure here, but I think this is potentially the best time to buy bonds. I think you're at a J-Powell floor. You're at the lows of the bond market from the second wave of inflation fear that people had during March, April, and May after we had 3 hot inflation reports in a row. You know, a quarter of hot inflation reports. Everybody's like, oh my gosh, second wave of inflation. You're at those levels, and people think Trump tariffs day one are going to cause all this inflation, blah, 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 blah. I don't think so. I actually think you have a much better opportunity seeing, bonds actually move up from here, and therefore yields move down. And I also think that today, I'm biased here as well, but I also think that today, Enphase finally hit a floor. We hit $59 3 days in a row. Boom, boom, boom. Enphase today up 5%, over 5%. My exposure is somewhere between 62 and 64, and I want a DCA on this because I actually think there's a good chance we're going to get back to the 75-80 line within the next few weeks. I'm going to make a whole video on Enphase and why I think that, blah, 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 but, anyway, we'll keep an eye on it. Ooh, Enphase, Bitcoin's bouncing a little bit. So I'll make a full video on it, and we'll break that down in detail. But I want to see quickly if Nick T has anything to add to this, but these are my thoughts. Now, another thing, too, if you're a member of the courses and you saw my fundamental analysis on Enphase, I made a new channel under stocks where we're doing sort of like a more forum format. I encourage you to check that out, and we can chat about Enphase there. And then let's go just take a quick peek to see what Nick Ramos has for us and see if he has any added commentary. He usually does. 28 minutes ago, the Fed staff modeled the impact of a tariff increase on economic activity and inflation and presented their findings in 2018. Powell was asked about this staff presentation. The staff basically suggested you could look through or not react to an increase in the price level with little lasting effect on inflation if inflation expectations were anchored and the pass-through effects of cost shocks were short-lived. Asked about that today, Powell reiterated that view and the view that it was too soon to tell. So it's kind of interesting. It's basically a way saying the Fed's just not going to really care about tariffs until they hit and then they see some underlying changes. So that's useful. So anyway, these are updates for you on what's going on with J-Powell, what's going on with the Fed, and some of my thoughts as well on Fed Chair Jerome Powell's presser. Remember, go to meetkevin.com/alpha to learn more, and then subscribe to the channel, and we'll give you some fundamental analysis breakdowns. We'll start with Enphase next soon. Thank you so much. See you in the next one. Goodbye, everyone. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.